Start recording.
Okay, great. And hopefully my, oh good, my Fathom recorder is going. Okay. Oh, did my screen sharing stop? There we go.
Good. Well, hello, Joel. Happy Wednesday to you.
Hey there. How are you, Mr. Tim? Welcome. It is
Thanks.
Thursday. No, it's Wednesday. Did we move the briefing
No,
from
we've
Thursday to
been on
Wednesday?
Wednesday. Like
I know
2
I'm
years
still in
ago,
the
we
habit.
switched it. I know. It's like, I don't think we did that. We also used to do it daily. You're not showing up daily anymore, are you?
No, I better not be, or else that's my bad. We did that for 100 days and then we said, okay, enough. Yeah, Zoom is exhausting, especially when you do it every day for, I don't know, we had 50 and 60 and 70 people showing up on those early days during the pandemic. So things are a little more calm now. But that said, let me say welcome everyone to this week's weekly briefing. It's Wednesday, October 25th, and I'm joined by my co-conspirator, Tim Thompson, founder at RevThink. And Tim, today we're talking about something that no one is thinking about yet, but 6 months from now, they're going to look back and say, oh man, that's when I should have been thinking about that.
Well, there are some people, my clients are thinking about this. So people we're doing one-on-one because we've been booking these meetings. But yeah, I feel like today is like a throwback topic. Early on, if Jason and I were doing anything at this season of the year, we were helping people gather together the year-end requirements and doing financial projections for tax reasons. And it's such a great habit to do it sooner than later in the fourth quarter, because some of the tax advice you get or some of the responses that you need to put out there take some time to work out. And you're doing that December 25th to December 31st, you're very limited in your opportunities to make that change. So,
So here's the thought, right? This is one of those topics that we're almost a little off center in a sense here, because the reason we get together every week and we take this 30 minutes is we're talking about a hot topic that's owners are talking about in the community, a trend that we're spotting when we're looking at data and things behind the scenes, or just something that's out in there in the news that everyone is saying, hey, let's get together and talk about this. But this is, in a way, Tim, the topic that when we were saying, what is the thing that no one's talking about but should be talking about, right? Yeah. So why would this be talking about taxes in what this is almost Halloween? Again, I know the answer, but I'm going to pretend like I am still running my old studio and I'm saying, seriously, Tim, why are we talking about taxes? It's Halloween.
Yeah, of course, it's a very Tim answer and a very Rev thinking way of doing it. We're talking about taxes because we're not actually talking about taxes, are we? We're talking about year-end planning. What we're talking about right now is Q1 2024 and what our cash flow situation needs to look like in quarter one. And therefore, what do we need to do in the next 3 months to be prepared for that Q1? Because if I have enough time, enough opportunity to collect, enough time to project, I can anticipate those needs. And one of the biggest variables in this season right now in that interchange is taxes. So really, you have to wind back really far to understand what we're really looking at. But I know with almost certainty, we need to have cash going into Q1 and be really, really set up that way. And if we're not set up in early Q1, we will lose out on competition. We'll lose out on opportunities. So we want our companies to be ready, poised for opportunity to put there. And these next 3 quarters allow for that to take place.
All right. So first of all, I love David's comment because taxes are spooky. Of course.
That's exactly why.
Right. That goes without saying. So let's do this. Let's give everyone a sense here of what are these things that so I'm going to say we as business owners. So if you're running a studio, you're running a production company, there's certain things that you're probably doing that drive your tax accountant crazy when next January, or certainly next February, March, April comes and they say, what? you did what last year and you're just now calling me, and you should have thought about this back in November, right? Is that our intention here, Tim?
Yeah, the reality is a lot of people do taxes in a reactionary way. They put all the data into a piece of software, they output it, and then they hand it off to somebody in a, because we don't like it. And we want someone else to do that for us. So then when the time comes way after the fact, you can do some forensics to determine what you did, but you can't really influence the end of the year. And for cash flow reasons and for tax planning reasons, there's some good opportunity. Let me give you an example. It's pretty common that people run their business on a cash basis. It's not my preference. I believe most of us should be on an accrual basis, but that's a different conversation.
Yes.
Yeah.
Right.
But on a cash basis, what we're often then told is, hey, if you want to save on taxes, spend the money now. So think about this. At the end of the year, when you need to have cash moving into Q1, we're told for tax purposes, get rid of all your cash. Okay, so we had $100,000 in profit. We go buy a bunch of equipment, or who knows what you're going to spend on that money. You drop down by 50 grand. So now you're only paying tax on $50,000. Good for you, maybe, but now you don't have that $50,000 in cash going into the season when you need it. Major harm being done. And the person giving that advice is a tax preparer. They're only giving you advice on that tax basis, not running a business. So I want to be able to look at far enough ahead if I'm on a cash basis and know what is my projected profit as I finish this year. I'm going to pull up my cash board. I'm going to look at my next 12 weeks on my cash board, because that's till the end of the year. Now I can see it. And I get a sense of what the revenue is, what my expenses are, and get a projected cash balance then, or a net profit balance then, and then do something different with it.
I would be curious to know if anyone here has switched from a cash basis where most studios start, and then have you moved to accrual basis? And if so, why did you do it, and what difference has it made? Because I remember going through that move. I want to say it's like around 2 million or so. It's almost mandatory, right? Like if you make that shift, it makes things so much smarter. I'll say this, it removes that crazy end of year, oh my gosh, we need to spend all this money because we're gonna, right, Tim? Like, I'm gonna buy this computer anyways next year, so I'll just buy it on December 31st. That way I get the tax write-off, right?
Yeah.
And I'm kind of reminded of, go watch the moment in Seinfeld when Kramer is trying to convince Jerry, well, it's all just a write-off and we're going to write it off. And right. And Jerry's like, you don't even know what a write-off is. It's really funny, but it's that point of, yes, if you spend $1, sure, you might save, let's call it 30 cents in taxes, but you spent the dollar. So the dollar is gone. I made the joke the other day, right? It's like this is a classic corny joke, but it's like the spouse who comes home and says, hey, I saved you $100 because I bought the suit or the dress on sale. And the other spouse is like, yeah, but you still spent $500. So did we save or did we spend?
That's what it is. Tristan, you did the switch over, right? From cash to accrual.
Yeah, so we did the switch over. For us, it was right about like 1.2. But we also work in a fashion where we're signing scope of works that are extended, 18 months sometimes. So we're taking payments on a kind of rolling basis across that. So it really made a lot of sense. Number one for that. Number two, we found ourselves at the end of the year having gotten almost $1 million deposit on a Spotify project that we were working on, and facing the reality of like, what are we going to do with, I'm not giving the state of New York 40% of that off the bat before the year's out.
Yeah.
Also, we are an LLC, and at that time we were not filing as an S, but we made our election to S at the same time that we did that. So it moved a couple of things. It allowed us to defer some of that revenue across 4 to 5 years. So rather than getting hit at the end of that year for the full nut, we were able to push that out 4 or 5 years later and roll that consistently. It also just worked better for us in terms of overall accounting, right? Given that the contracts that we work on function in that way, it's usually like deposit up front, and then maybe we're delivering, 18 months later sometimes in some cases. Some of them are shorter, right? If it's a live production thing and it's within 6 weeks or whatever. But most of the time we're seeing an influx of money before we're delivering the actual goods, which for cash basis doesn't really work.
So let's explain on that example exactly. So let's explain what accrual is doing, right? When you first land a project, the client gives you 50% up front, but you have no expenses against that project initially. If you were to, because taxes are somewhat on an arbitrary basis, right? It's just a date that they choose as a deadline. If you got that first 50% payment up front and no expenses against it, that whole payment looks like profit if you were to adjust taxes. So what accrual does is match your revenue to the expense. So that way you can get the revenue up front, the $100,000. But if you have zero expenses, none of that revenue is counted yet. It's not counted until you spend the money on the expense side. So if you're 25% through a project, you recognize 25% of the project's revenue. If you're 80% through, you recognize 80%, even if you haven't received the money from the client yet. On a cash basis, it's only about when the money goes into your checking account and out of your checking account, which is really good for a bakery, a cost of goods sold business. But what you're talking about, a project-based basis, we're getting uploaded and we have to manage. And back in the day, people used to, clients used to offload a bunch of cash in our checking accounts and like, hey, I'll do this next year. And if you're on a cash basis, you're hitting major taxes in the year and had no control over it. So that switchover is really important. Yeah. Thank you very much.
Yeah, no worries.
Yeah. Thanks for sharing that, Tristan. Yeah, Tim, I think you kind of beat me to it in terms of the summarizing up of like, oh yeah, if you could influence when you realize income versus when you realize expense, it's a little bit more work, but wow, that's a lot of control, right? And that's what we normally don't have control when we're dictated by things like December 31st, right? A client just sent us a giant check. Oh no, right? Yeah. Now those taxes are due and all those kinds of things. So this is one of the habits. I'm trying to think how we would express it, because the thing that we had written down in our notes here, which let's respin it, was you're not aware you generated several $100,000 in profit this year. And now next year, your accountant is looking at you and saying, what? You didn't see this? You didn't realize that when this client gave you this big pile of cash, it was going to have an impact on you.
Yeah. And the pickup there is basically often when we finally calculate our taxes, let's say March, right? All that money is so gone. And now you're paying taxes on something and the cash itself isn't really there. So then you are taking what should have already been paid in tax liability or recognized in tax liability set aside. Now you're being hit at the last minute for something because you just didn't have the visibility of what that end of year requirement was. But if I look at it now with 3 months to go, and if I made regular quarterly tax payments or contributed slowly throughout the year, or at least saved slowly throughout the year, and I have 3 months to really kind of get close to what that nut is, when the time comes and those taxes are due, I have that money sitting in my tax savings account. So it's almost like a non-event. And the good news is then I'll get my taxes done sooner. I'll get them done in January and February instead of October, November, or whatever, September, October, when the extension's done. And we really stay up on our liability that way. Taxes are just not fun. I was like, if they're not fun, get it out of the way. It's why you eat your vegetables first and your dessert last, right? Like, just get out of the way. You need to do it, but let's save the good stuff for when we want to. Why stretch it out for months and months?
I remember one moment when, I don't know, we were paying, I was running my studio, and at our peak, we would pay a quarterly, right, tax. I'd write a check to the government every quarter. And I remember one quarter it was $70,000 or $80,000. And I just couldn't believe, right? And you immediately think, this can't be right. I can't pay this. But then I thought, wait a minute. The beautiful thing is we have the money. We're that, right? We have that much revenue, that much profit that I can afford it. So like you said, it's like, just get it over with. Send it. Goodbye. Because thank goodness we're generating that kind of revenue that we can actually afford it. And that served me well at that time. But let's get into habit number two real quick, because we kind of already talked about habit number 2. It's this idea of, you plan on spending cash before December 31st in order to maximize write-offs. So do you have a pithy, like, why is that a bad habit? Why is your accountant next year saying, wait, why didn't you call me before you did that?
Well, there are just so many different types of, we'll call them good expenses and also bad expenses, right? So a good expense, by the way, is like a depreciation on an asset. So you buy into an asset and the asset over time loses value, and you can write that off. And there are some amazing write-offs. So if you buy real estate or certain property values, a big portion of that initial purchase becomes a write-off, but the asset itself retains its value. So you buy a house or buy a piece of real estate, and you can write off 50% of it as an expense, but you still can maintain the entire value of the house on your balance sheet, and you can go get that money back later on. It's such a great tax play. If you wait till the end of the year before you start asking questions like that, those opportunities don't exist. You can't, there are no, those good expenses aren't there. So then what people do is they buy television sets or, I don't know, computers or monitor, like an extra monitor or whatever. And they're really just spending money justifying it. Yeah, but I might have bought that camera anyway, so might as well buy it at the end of the year, and so on. And what a major hit that is to you as a business planner and a strategist. I want to save my cash now to spend on a person when everybody else can't hire them and I can hire them. My team grows and I win pitches, or I can get myself into sales opportunities I couldn't before. So when other people are not in a cash position and I am, I'm on a winning proposition. I can take more risk and get more reward for it. So that's where I believe Q1 often is for people. And I want to be planning at the end there that way. I don't want to do dumb expenses right now.
Yeah. So what I heard you say there is the habit is don't wait until the end of the year, a la December 31st. Like, have the conversation now with that tax person called, hey, I've got 3 months to make certain decisions. Help me sort of balance out my bad expenses with some good expenses or something like that.
Yeah. Or, switch me from cash to accrual. We have 3 months to do it. Let's not wait till the last minute, right? But the opportunities really are to look at yourself and say, yes, you can hear me. I plan 1 quarter ahead. So I'm not spending money right now in Q4. I'm spending money right now of Q1, because that's what Q4 allows me to do, is be set up to be successful in Q1. And as I do that, I'm thinking about what I have with projects coming in, expenses that I can put out there, opportunities, also obligations like taxes. So I want to be thinking about 2 or 3 steps ahead as I make these decisions. End of December, you're just kind of being silly, the spending spree, really.
All right. So what about this one? I'm going to pretend I'm living my former life here again, and I'm really bad about receipts. I can't be bothered. I know my team is supposed to be gathering up receipts, and my producers should be gathering up those receipts, but we don't really have time to do it now. We'll do it later.
Yeah, the downside of not basically doing your homework, right, maintaining the floor in a way, is that it will catch up to you, especially when it comes to planning. One thing we want to do right now is start doing your 2024 factors report, which means I have to have some good categorized information to see where that money goes and different influences I can have over those expenses. If I'm looking at your Q3 quarterly reports and Joel, you don't have everything categorized, you don't have your subcontractors split from your staff people, let's say, and all I can see is just one big bundle of money, and you're overspending by 5%. I could guess you should probably get rid of freelancers, but I can't see the details of the data. But if you give me just that little split of your staff person and your subcontractors, they both go through payroll, but we kind of know the difference between a temporary employee and a full-time employee. Then we can identify the specific individuals and say, hey, we need to cut a 5% difference. We need to increase utilization of certain individuals. We can see that information and have influence over it. So that's like, if you just wait, and especially like, when are you going to do it? Next March? So I can't really tell you what your 2024 numbers should look like until April. If you're 4 months into 2024, that seems like, not a very good position to be in.
So tell me what you think of my latest little sketch here, Tim. Does this?
Wow, you're getting better and better at that. Is you having a computer draw that for you now, or are you just practicing on the side?
I'm just, it's my part-time hobby now, drawing cute little diagrams. But for everyone here, just when you're wondering, like, well, what is the factors method? It's this idea of we divide all the money that comes into your company into creative costs and company costs. And that determines the splits. That's the ratio, because you're going to give all that creative cost money to your producers, but all those other costs are not decisions your producers make. So what you're basically saying here, Tim, is in order for us to make these decisions of what should this ratio be, I got to know what are the different categories there. So if I don't have receipts entered and my bookkeeper's on top of that, you're just looking at a giant pile and saying, I don't see the decision points here.
For some reason, after looking at that graph, I have a craving for orange slices. I don't know what it is, but there's something about that.
Or a piece of pie.
And really, like, you did a good job. The little cuties things, the little kind of little slice. Yeah.
I'm trying. I aim to please. So yeah. So what's the encouragement here other than get caught up on your receipts? Is it something more like it's not that hard to create a system and to delegate and have a bookkeeper? And
yeah, it's right. Systems and routines. So you need a good system, QuickBooks, Expensify, whatever. You need a routine, meaning a person that does a task on a regular basis. If you don't do it, hire somebody. Bookkeepers are not the most expensive people. $16 to $25 an hour. Some are 50, but if you're at that level, great. And then you bring your receipts in once a week. They reconcile them. You bring in look at your monthly report. You look at your quarterly report. So those things roll up, weekly, monthly, quarterly. And if you're doing that stuff on a routine basis, every week, every month, every quarter, you'll keep up with it. You'll love that data. And I think we become addicted to it. You almost think of, wow, I need to go find those receipts. I want to get that information out of my bookkeeper and out of this data. That's what we want to get on that side.
Give everyone this encouragement too. If I said, well, Tim, I'm running a $1, $2, $3, $4 million a year company, I still can't really justify hiring a full-time bookkeeper. You would say, I didn't say full-time.
Yeah, I say don't. Right. I mean, bookkeepers are by the hour or by the task. A lot of them you can create a flat monthly rate for. I think Jason can probably give me a more accurate numbers of what they go for, but like $1,200 a month, $600 a month. I don't know. Give me a thumbs up of like, hey, what a round number is, but you can for $600
a couple hours a week.
Yeah. A few hours a week, or every other week they come in, they reconcile things for you. And there's so many other benefits. We're not talking about that, but for cash flow purposes, business project tracking purposes, many other areas that they can help you with and get that visibility. I think it's the first person you should hire.
Right. It's this, you always say, fire your mom, hire a bookkeeper.
That's right. Right. Because the fire mom's for a different reason, but it's like you really want someone that will give you that business advice. There's this other byproduct, and I know I'm pitching bookkeepers, but there's this other byproduct when a bookkeeper is working for multiple other firms. The idea of end of third quarter tax planning, they're doing that for 6 or 7 people. They have other routines that they're bringing into your business and giving you their good habit, instead of you hiring a full-time person or having somebody that just does it, your mom that just does it to help you, but aren't in that routine of it. You're not capturing the benefit of, the whole mojo of a whole world moving around and fitting into the bigger cogs.
So habit number 4, I think we already touched on, because we were talking about this, come March or April next year, if my accountant says to me, wait, you're still on a cash basis? We haven't moved you to accrual basis. And the bad habit that I had for many years was, what does that mean?
Yeah. Yeah.
Right?
Gosh, I don't know. I wish I went to accounting school for like the week where they taught accrual, because the aversion that accountants seem to have to that when you're first bringing up, and I don't know if it's that they haven't never done that transition before or what it really means. But I'll say this, there is a transition when you go from cash to accrual. And Tristan kind of talked about that. It's in that first year, you have to distribute your profits out over a few years. That way it's basically not just gaming the tax situation. And that process, if if the person you're working with isn't familiar with it, they might hesitate to move forward. But the other one is this: I think that they're not used to a production company that always delivers, understands, has a roll up, and can talk about what percentage of a project is completed, which is one of the things you need to know when you're doing the accrual basis is how finished are you? What percentage of this project are you done? And the fact that we're running roll-ups and we can easily look at project and project growth, it's very easy for us to answer. I'm going to guess most businesses can't do that. So they almost downplay it and talk about the difficulty of running an accrual process. It's not difficult for us at all. You know, if you're in a production company, you know what percentage of a project you have done. You talk about that percentage, you match your revenue to the percentage of the revenue to that percentage of completion. You're pretty much done. It's an easy Excel sheet, or you can do it on a piece of paper and pencil if you needed to, you know?
Well, it is a bit embarrassing though, because I'm thinking back to when I was running my studio and I wasn't running the factors method. If you had asked me what percentage of is the job done, you know, how much of that expense can you realize against that income? I'd have been like, well, for numerous reasons, it wasn't well tracked. But now when I think about the systems that we recommend people run, it's actually, I could open up my phone right now and look at any one of my clients and all their projects and be like, that one's a third done, that one's half done, that one's 10% done. Like, it's just right there all the time.
Yeah. Yeah. I mean, Joel, no one on this call isn't tracking it. Everyone on this call has a roll up. Everyone here knows what a factors method is. We're not. Yeah. See, Tristan's like thumbs up.
Right. Of course.
Nobody. There is no way you've listened to 1 or 2 daily briefings and not know what the magic of the factors method is and how it works. I don't know what Tristan just did on that effect, but what the heck was that? Yeah, that's the way to do
magic,
it.
The magic, yeah. And it's the Apple, whatever. Oh, look at this. Holy cow.
Dude. Is that what you do?
I was gonna say
Zoom is like playing games with us nowadays. We get some responses. This is great.
I think it's this fancy phone that's doing it.
Oh yeah.
Well, here's what we should do, Tim. Let's like, if someone was like, hey, I heard something about factors method and I heard something about tracking my projects and all these kinds of things. What would be the encouragement? Like, where would we send them in the community to learn more and to dive in and all that good stuff?
Yeah, look, there's a search bar at the top of the community. Just type the factors method and you'll see meetings videos that we've made, weekly briefings that we've had, or posts that are out there already talking about it.
I'm gonna take you to task on that real quick.
Yeah, sure. Just type factors.
There. Yeah. Oh yeah. Well, here's like,
yeah.
Right. So this is like a quick crash course that we created, which isn't live. So shame on me.
Yeah.
But yeah, you can see here, there's so many, 70 posts about factors and 52 comments, 3 lessons, events. So there's a lot of good stuff here. And especially, Tim, you and I taught this inside of Confab. So now a lot of members that are members of Confab will go back and watch those replays, because it's like, oh, here's the 4 or 5 part series where we walked everybody through the entire method and they built it themselves. And here are the spreadsheets. Here's the blank template. Just go for it.
Yeah. And we have roll-ups. We'll give you a roll-up light, a really simple 5-column process to fill that in. And to be honest, if enough interest, I'll jump on a call. I'll do it as a small group or something. So
right.
Someone make a comment and give me some thumbs up, and Eric will book that meeting. I'd be happy to talk about that any day of the week.
Well, I will also say to everyone, please be on the lookout, because we are going to be making some announcements maybe in the next month or so about the community and the plans for next year, about the accelerators that we're going to run first quarter of next year. So there's a lot of really cool things in the works that I think people are going to find.
Oh, I'm so excited about some of this stuff that we have. We'll start teasing it out, but man, oh man.
Yeah.
Let's just say Joel and I dream big, but we need your help to do it. So join us dreaming big.
Well, thanks to Tristan for jumping into the hot seat here momentarily today. And yeah, looking forward to seeing you here in the city soon, Mr. Fireworks. And Eric, I think I'm doing a podcast with you soon. I see your smiling face up there. Yeah. Okay. He's staying distinctly on mute today. Oh, there he is.
Uh-oh.
Here. No, I'm looking forward to it, man. I just wrote up some questions and notes I'll shoot over to you.
Love it. We're going to have a good time. And everyone else, thanks for being here for the weekly briefing. Tim and I always appreciate seeing all of you. We'll be back next week with a topic of which I have no knowledge, because we can only, we pick it a few days before on a good day, Tim, right?
On a good day.
But we'll be back next week for another break. Between now and then, hopefully we'll see most of you in the community. Tim, have a good rest of your week.
Many blessings to you guys. Have a great week.
Bye, guys.